And good afternoon to everyone. So just to recap, just a little bit on the first quarterly call, because obviously that was at the kind of the start, or I don't know, the peak or whatever it was of the virus starting to impact global markets. And I think what we said then was that we were looking at 3 data points to make us feel more constructive towards markets. The first one was obviously the number of positive cases starting to slow, which we've obviously seen globally. 2 was the reopening of economies, which we've seen globally. And the third point was for the VIX, the volatility index, which is then hovering around 80, to come more to under 20. And that's the only one that's probably not reached the kind of expectations we had, as it's still hovering around 30. So we still feel it's going to be, a volatile, more trading type market in the shorter term. But I'll let Vaibhav talk more about that in terms of what we've been doing in the portfolios. So, our view remains that we're probably in a more of a U-shaped recovery, even though we've seen the reopening of economies. We are seeing yet another increase in the number of cases. Initially, thoughts were that, yes, it's the younger people in the US and elsewhere, but that age or the age range has kind of moved up to the 40 level. So it is rising as we speak. So we think it's going to be a bumpy road. We don't think it's going to be an easy path. So this initial V-shaped recovery, which we saw, with people spending outside of essentials, is starting to flatten a little bit. Obviously, because confidence gets dented to some extent, and we'll see how that plays out. But overriding everything at the moment is liquidity, and that always makes us kind of look at things a little bit more rosier as markets move, continue to move higher. So we're a little bit wary of liquidity-driven markets. We never know quite what. Or quite sure what would prick that or burst that bubble. But I'm sure all the kind of negatives that we think about would be wheeled out as the reasons why markets are falling. So I'm not going to talk too much on the global part, because I think a lot of it you would know in terms of the news headlines. But we'll see over the next few weeks how some of these concerns may have impacted the kind of mobility figures and consumer spending. To that extent. So, to move into India, if you can go to the next slide, Nancy, please. We had one of the strictest lockdowns actually from March 23rd, if I remember. Despite that, we have seen an increase in the number of confirmed cases in India. It's running around about 24,000 at the moment per day, and mainly, obviously, Mumbai, Delhi, being the two main hubs where you're seeing the most cases. On the positive side, if you look at the next slide, is that sorry, not the next slide, is that the recovery rate is very high at around 60%. So maybe that's a combination of the fact that we have a young population. I'm not quite sure. I haven't seen any stats on that. So whilst the numbers, will continue to rise, the recovery rate is very high. So that is the good news. I suppose the litmus test for me would be in Mumbai, when local passenger trains, start working, because that obviously carries a lot of the workforce in Mumbai, and see what would happen then with the number of cases. But for the time being, yes, it's worrying that it's rising. But the recovery rates are high, so that's the good news in that respect. Next slide. So, India, in terms of GDP growth, in terms of negative growth for the year, the World Bank projections are around about minus 3%. There are figures out there by other major brokers, such as Numora, saying nearer to 5% negative growth. So we are seeing those numbers going to range from around -3 to -5, but compared to other places, it's still relatively better off. Given that we are a domestic-driven economy, and therefore, you know, we can see, you know, kind of different. We're not reliant so much on the global growth for our growth. So go to the next slide, please. So what we're seeing in terms of the opportunities is really on the longer term, you know, kind of long-term reforms, which, you know, we're starting to see come through. And I think part of it's to do with obviously what we saw even before the virus with China and their trade wars with the US, that was a great opportunity for India in the longer term to you know, to garner some of these manufacturing bases away from China and towards India. And I think COVID has probably accelerated that process. So, you know, India with one of the lowest tax rates in Asia, you know, should be able to attract a lot of these companies. I still feel though that, you know, it would be helped enormously by the government rolling out that red carpet a little bit more with labour reforms and land to help companies, you know, kind of, you know, ease of coming into India being a lot more clearer for them going forward. We are seeing some of the states actually, you know, kind of have their own labour reforms to try and attract these companies. So, you know, if that continues, then that would be good across India. And I think, you know, there'll be competition within the states to kind of, you know, find that they want to attract this foreign investment. And, you know, to some extent, you know, we're seeing the interest in that mainly through Reliance, where you're seeing a lot of companies that, you know, seeing the potential in India, and obviously through Reliance are investing quite heavily. But that's just one, you know, one specific company. So we would, you know, we'd want to see more and more foreign companies come into India as a new manufacturing hub and shift their reliance away from China. So we think that will happen. It's obviously a longer term reform, which would be helpful for that to take place. But if it does, then obviously it's very sticky foreign direct investment, which would be good for the long-term growth of India and obviously employment going forward as well. Next slide, please. So in terms of the what we're seeing on the ground is obviously we're starting to see a pickup in demand across a number of sectors as the lockdown has kind of moved forward across different states, and you're seeing the initial pickup in demand outside of essential goods. And, you know, the auto sector, particularly tractors, has done very well. Maybe there's been some pent-up demand, it's difficult to say, but obviously, you know, we are seeing some very good figures from the tractor companies. And, you know, our kind of dealings with the auto distribution companies and dealerships are saying that they've seen a very big pickup in obviously inquiries. And their feeling is it's more towards maybe people wanting to have their own transportation away from public transportation. So this might be a trend in the short term that we'll see and will help auto sales going forward. So, you know, we are seeing a gradual move back to the workplaces. In Mumbai, you know, we can, offices can now have 10% of the people in the workplace. So that's a trend which has been improving. But again, I think for the workplaces to show more kind of increase in number of people would be for the lockdown to kind of ease a bit further and for local trains to start operating. So overall, you are seeing, you know, like we've seen in other countries, that initial move towards spending more, and a lot of that's come from the rural side of the economy. And if you can go to the next slide, please. And what we're seeing there is obviously a lot of movement of people who have gone back to the villages, but they're still being employed under the NREGA employment policies put out by the government, so that they do have money. But you've seen obviously you know, the start of a good monsoon, so we are seeing a lot of traction there from the rural economy in terms of a pickup in spending, and that's, you can see in the charts there how things have moved in terms of the kind of number of trucks moving around to the unemployment rate coming down as those people who were migrant workers have moved back to the villages and then being employed under the NREGA schemes. So that's the good news from the rural economy. Next, please. Which is obviously backed up by the electricity consumption, starting to get back to normal. So, most industries now are back to around 50 to 60% capacity utilization. I mean, it's obviously, FMCG companies are running a lot higher, but in general, a lot of the, those affected industries, pure manufacturing companies are now getting to the 50 to 60% or more in terms of capacity utilization. So again, that's a good sign that the economy is starting to recover and that people are out and spending outside of their essential goods. Next. So I think I've said that this is where we've seen the rebound in vehicle sales. Obviously, two-wheelers have seen a smarter recovery, but we are seeing that the dealerships are saying that the move towards cars is starting to pick up as well against kind of public transport. So that's a trend that we think we might see, and obviously a lot of the companies are now banking on the festival season coming up, September onwards, as a boost to help the sales going forward. I think the one thing that's still missing though is obviously the government has been stingy is probably the right word in terms of their fiscal packages, which add up to around about 2% of GDP. So there is a feeling that once lockdown has come to an end, that the government might come in and step in and do some more kind of give more incentives to those industries, particularly on the leisure side, to boost the spending and the consumer confidence that things are all moving forward. So that's one of the other things that we'd be looking forward to in the next few months in that respect from the government. So let's hope that comes through, because I think that would be an extra boost that the economy needs at this point of time. Next. So, the rupee, I think there's a lot of concerns at the beginning of the crisis, and I heard a lot of people ask me, is the rupee going to 80? Our view at that time was, maybe it's a kind of a wide range, to be fair. We were saying more between 74 to 77. And that's really where we've been kind of, we've been situated. The government, the RBI has done a good job. The reserves are higher. We've even seen now, capital account surplus, partly because obviously imports have fallen so much. And we've seen a lot of foreign direct flows. Without going into the details, we've seen about just in terms of Reliance was $14 billion. And other kind of large companies which have issued shares recently would add another 5 to 6 billion. So, you've seen that in a very short order of time. So obviously that's helped stabilize the currency. Obviously there's a feeling that the dollar may weaken in the near term as worries about Biden becoming the next president in the US worry people, and there's diversity outside of the US. So that would be good for India in terms of emerging markets and obviously the currency. So we still think that range is still about right, 74 to 77 in the short term, not excluding that there's any kind of blowout in any other emerging market, particularly in Asia, which would have just a temporarily kind of sentiment effect on the currency. So again, one of the better performance currencies compared to other emerging markets. Yeah, and in terms of the the reserves, and which I just mentioned, has continued to increase. If I go into the next slide, we've also seen that the RBI has been very active in reducing interest rates. We probably think they've got another 50 basis points which they can do in the next quarter. If the monsoons, which we're seeing, are above normal at the moment, and that's one of the concerns the RBI would have in the very short term, is reducing rates if there's a possibility that the monsoons were poor, and that could have an impact on food inflation. But that's not looking the case at the moment. So maybe around September, October, we could see the RBI again coming in and stepping up on the interest rates and let's say we think there's another 25 to 50 basis points reduction that the government, so the RBI could make. And I suppose it's all then about the transmission of that to corporates. But again, we've seen that the RBI has been very active in trying to get some of this working capital to companies, mainly through the public sector banks rather than the private banks. But we are seeing obviously that the public sector banks are doing what they have to do to help a lot of companies through the working capital problems which they're facing. So a further reduction in interest rates, I think, would be very, very useful and very helpful. Again, another kind of confidence booster, for not just for the markets, but mainly for the economy. So if you get the combination of the government with some fiscal policies to help, some of those industries which are suffering quite badly and have working capital problems, and the RBI stepping in as well and doing a bit of the heavy lifting in terms of reducing rates for those working capital loans, I think would be seen very positively by the markets and obviously would be good for the economy going forward. So that's just a brief on the overall economy. So you can see that there are green shoots appearing. Some of the mobility figures, do say that there's a little bit of flattening off. That could be because of the increase in number of viruses, but that's a trend that we're seeing globally. We think that this momentum will continue in the very short term as we go towards the festival season. We're just about to enter the results season, so that will give us some good guidance from corporates in terms of what they're thinking and what they're seeing. So I'll leave it at that and let Vaibhav talk about the markets and the portfolios.
Sure, thank you, Andrew, and thank you very much for being on the call, everyone. So what I'll do is basically I'll just give you a brief on what we think in terms of the markets, why the markets are moving the way they are, what is the outlook going forward, and how are our positions, or what we have done in the last quarter, and how are we positioning the portfolios going forward as well. So if you look at this kind of chart, which is global M2 supply, what we have tried to do is basically try to have a correlation or a comparative graph versus the currency and the Nifty. What we do see is basically there is a good correlation in terms of whenever the money supply globally has been increasing, you have seen money supply coming to emerging markets. And when it comes to emerging markets, of course, India is a natural beneficiary of that emerging market flow as well. And because of which we have seen that higher the liquidity on the global system, you get some decent kind of move both on the currency and the Nifty, which is favorable. This time around, what we have seen post February, March is the amount of liquidity which has been infused, or M2 which has been infused in the global system, is just unprecedented. What it means is basically, yes, while the valuations on the, or the movement on the market looks a little, pretty fast or pretty quick in a very short period of time, but we do think that, the global liquidity supply will continue to rule the market movements globally. Having said that, I'm not saying that the markets are immune to the shorter term risks, which Andrew did mention about the increasing cases, the corporate profitability on this quarter, which is going to be extremely weak. After that, you might see some amount of number revisions coming into FY21 and FY22 as well. But all in all, the liquidity would be such a big force that these kind of issues would tend to get swept under the carpet, at least for the short period of time. Also, the other thing which I would probably want to mention here is basically if we look to see this kind of liquidity post the potential treatment or vaccine which may happen, then the amount of flow which may come into risk assets can be disproportionate. And that is where you might see that the valuations expand pretty quickly in anticipation that the businesses are going to get normalized pretty soon. And whatever has happened in the last 6 to 8 months because of the virus is in passe, is one-time event, and people will be looking forward to steady economic growth probably within a year or two, probably from there. And that is why we do think that this is one of the very important charts which we need to consider, is basically that the liquidity is going to be in the system for an elongated period of time, where Fed has also guided that by FY21 calendar year 21 year end, they are not looking to kind of increase any rates. Next slide, please. Again, this is a reflection of how the liquidity has actually turned out, at least for India inflows. And if you look at India inflows, we have been getting some amount of positive flows, and if you see after the huge sell-off from March 20, from April, May onwards, we have seen some stabilization and starting to get some amount of inflows as well. Also to add is basically good quality corporates, which is the figure 3 in this slide, does show you that they have been able to raise capital, especially if you talk about, apart from Reliance Industries, which have done fantastically well, but apart from that as well, you've seen many banks like, Kotak Bank and likes of others, raising huge amount of money and strengthening their balance sheets in this kind of time period. Essentially what I'm saying is basically here that the liquidity is not an issue. Good quality corporate is getting money, is kind of making the balance sheet strong. And once kind of things stabilize is when you will see that these kind of stronger companies who have been able to raise capital would be the ones who would probably garner the maximum growth or capture the market share, incremental market share. And point in example is what we have seen in HDFC Bank in this quarter provision numbers as well, when they kind of grew their credit growth, or they had a credit growth of about 21%, when the system-wide growth was less than, even 7%. Right, so these are the companies which needs to be found and kind of probably be invested, and capital would be available to them, looking at the overall liquidity environment, which is benign, and probably that ample liquidity will find money into corporates. Next slide. In terms of the valuations, right? I mean, here we have two charts, which is your price to earning ratio and price to book ratio. The reason why we are looking at price, I would not want to give extra stress on price to earnings ratio is purely because the earnings are probably dislocated at this point in time, purely because because of the virtual lockdowns, and people have not much of a clue of what's going to happen, at least in the earnings for FY21. Of course, FY21 earnings are going to be pretty bad, but I would not kind of P is not a measure at this point in time, purely because they are dislocated, and I would rather see P in those kind of environment where it is normalized, business environment, and therein where you will see corporate profitability probably coming back into shape, right? And if you look at the price to book ratio, it's still trading pretty cheap. Having said that, it's recovered from the lows, but still on a comparative basis, it's much below the averages and much below the history as well. Which gives me some amount of flavor, saying that if you're looking at price to book value multiples, then there is a possibility that you might see some amount of favor, at least for the value stocks, at least in the immediate kind of short term, where you are seeing some amount of weakening in dollar and some amount of value buying, which is happening currently, both in the global and the local markets, as well. Once the situation kind of stabilizes is when you will again shift focus from value to growth, and that is where we would be dynamic in terms of shifting the portfolio constitution as well. Next slide, please. In terms of the Indian market cap to GDP, again, from a low of about 54-55%, we've seen market rising, and now it's close to about average multiples in terms of market cap to GDP. Again, here the GDP forecasts are all over the place. Maybe in a quarter's time, when we look at GDP forecasts kind of stabilizing, is when we'll be able to grasp a proper ratio on this. But at this point in time, looking at the history, we are at the average levels.